Welcome to Patterns Trader, and we're taking a look here at trading chart patterns. Patterns Trader has been developed to historically record and identify chart patterns. The way this is done is with a complex computer algorithm that identifies turning points in a share. And once the patterns are identified, it's possible to analyze those patterns and find out historically what works and what not. Trading chart patterns has been very subjective in the past, and people swear by them. Some analysts say they're fantastic. However, today we're going to take a look at the truth. Is that the case? Over the last 8 years in the Australian market, we've identified around about 5,775 ascending triangles. So if we come in here and we go down the bottom, 5,774 ascending triangles. We have all the historical data for these patterns, where the entry price was, where the exit price was, and how many points or percentage gain we made on the trades. We also have all the dates of entry, the dates that define the patterns, and a number of other parameters associated with these chart patterns. We can analyze this data using pivot charts, which are built into Microsoft Excel from around 2003 onwards. With pivot charts, able to analyze a large amount of data very quickly. We're looking now at all the ascending triangles from 2000 through to 2008. The average return during this time has been an average gain of 1.33% on the long side, with 3,600 trades and a 49.8% hit rate. The average trade is held for around about 9 days, or just under 10 days. On the short side, ascending triangles haven't performed as well, and that's typically what you'd expect trading ascending triangles. And we can see there that they've averaged 0.36% gain on 2,000 trades. So most of the time an ascending triangle breaks up, and overall it is a profitable pattern. But we can definitely improve on the results we've got here. Now with a pivot table, we can actually have a look at all the possible characteristics of that pivot table in here, all the data that we have, and we can very easily analyze a particular data. We'll look at some simple ones to start with. Now when you're optimizing or filtering, which is what we're aiming to do, is filter out the best patterns, you're better off working on one side at the time, because the long patterns that you're filtering for, the market conditions or the conditions are likely to be different from the short patterns. So we're only going to take a look at long patterns today. Turn off the short patterns, and we're just going to put this up the top here, which means that we're now looking at the long trades. Now one of the first things we want to see is the trend of the market. It would make more sense that when the markets are up, ascending triangles perform better if we're trading on the long side. So let's take a look at that and see if that plays out. We simply drag from the left hand side over to the right, and we take a look at all the patterns. Now here 0 stands for sideways, 1 is down and 2 is up, and so we move across and we can see that when the markets are down, ascending triangles perform quite poorly. They actually lose money. When the market's consolidating, they make an average of around 1.4%, and when the market's going up, the average is 1.6%. So we're not really interested in trading ascending triangles in a falling market. Now that we've set that, the same applies to the sector. If the sector is rising, we would expect that to support an ascending triangle trade in that particular sector. So having a look at that, 0 is one is going sideways or consolidating, 1 is down, 2 is up. And we have a look at the results, and it's not so obvious this time. The market does underperform slightly when the sector's down. So we've got 1.35 here as opposed to 1.4 when it's consolidating, and 1.78 when the sector is rising. So it's not as important what the sector environment is for the time. But the better trades are found, 53% success rate and 1.78. with the sector rising as well. So we turn off those two, and we now get into these particular trades here. And as you'll see, as we apply more filters, the number of trades drop down and we pick up the better trades. Now the trend of the actual share, does that make a difference? And if we have a look at what the historical trades there, we've got 0 sideways, 1 down, 2 up for the actual share. And if the share's going down, it's actually a reasonably good trading signal. 2.3% average and 2% if the share's rising. Only 1.5 or 1.4 if the share's going sideways. Now with this gain here, there are a lot of trades, 680 trades. And if we simply turn that off, which we can improve our results quite dramatically. However, we do cut the number of trading opportunities down significantly by taking away 680 trades. So for now, we're just going to leave the trend of the security as it is. In a similar way, we can look at other parameters, such as the height of the pattern, the length of the pattern, where it breaks out in the pattern, or the volume that's associated with that pattern. The turnover, there's a wide variety of data. So let's take a look at apex position. Apex position is the length of the pattern. How long is it? And what we can see here is it's been grouped in groups of 5 days. Now if you don't like the grouping, you can change it by right-clicking, group and show detail, group. And you can start at 0, go through to 60, and jumps of 10. Tell it OK, and we'll re-sort the actual groups. Now we can have a look through here. Is there any pattern or trend to the price action here? And the length of the pattern, this is how long the pattern is from the start to the point of the pattern. There doesn't appear to be any strong correlation. The longer patterns here, 40 to 60 days, seem to deliver bigger results, but once again fewer trades fall into this criteria. But you could filter out the shorter term patterns. We go back to the original grouping that we had, right click, group, and we have a look from 0 to 50 by 5. We see that the very short patterns here, with 0 to 4 days in the length, don't perform well at all. In fact, they pretty consistently lose money through the years. So we'll be avoiding those patterns, but the rest of the patterns, there is perhaps some bias to longer patterns performing better. That certainly exists and is clear again in this chart. But the ones we're really not interested in are the very short-term patterns. So in a similar way, we can work through many of the other parameters and drag it up in here. Now bring the trade type back in. We can see that on the long side, our average return is now 1.75% on the trade, and our average hit rate is up to 53%. And we have around 1,000 trades, about 200 trades in a year on the basis of this. A few less in 2008. In a bearish environment, you'll get less long trades. But however, profitable overall, and our average hold has gone up slightly to 10 days from the 9 that we started out with originally. You can work through these spreadsheets and build your own trading strategies, run your own filters to determine when you trade a particular pattern. I wish you successful trading.